And under a fixed price gold standard, you have to realize sovereign debt has no default risk because the government can always print the money. And so sovereign debt really has only inflation risk. And if you have inflation risk, when you're on a fixed price gold standard, when the government starts to inflate, interest rates don't necessarily need to skyrocket much, much higher, but rather the gold starts to move.
I think, first of all, I think they're doing the right thing, and I think they know what they're doing. They're no fools. Buying gold is a smart move in the environment we're in. After all, we've got a lot of things which say that gold really should go higher.
A world split between a Bitcoin-backed West and a gold-anchored East sounds clean in theory until you remember that global trade never stops. Even rivals can't avoid exchanging value, and that's where the neat lines start to blur. Luke Gromen argues that a hard separation between a U.S. Bitcoin bloc and an Eastern gold bloc is unworkable because trade inevitably creates a real exchange rate between the two assets. Even in periods of intense geopolitical tension, goods still move, and with them flows of currency and collateral. Any attempt to isolate reserve systems collapses the moment a barrel of oil, a chip, or a ton of copper crosses the border. Luke Gromen emphasizes that productivity is the ultimate tiebreaker. Even if the U.S. tried to outsmart China by revaluing gold and shifting into Bitcoin, China could instantly reprice strategic exports like rare earths in Bitcoin and pull purchasing power back its way. That's why he sees technological acceleration in AI, robotics, and advanced manufacturing as the true battleground. Luke Gromen also explains that China and Russia's pivot toward gold is a rational response to U.S. debt dynamics. Under a gold peg, inflation causes gold outflows. Under a fiat system, inflation simply erodes the real value of foreign reserves. Holders of treasuries get paid back in dollars that buy less, which turns monetary policy into an external tax. For countries worried about national security and reserve stability, gold becomes the safer choice. And if the U.S. is serious about reshoring and rebalancing, Gromen argues it will eventually need a meaningfully weaker dollar because the only way to make the math work is through devaluation, not higher yields. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Maybe, but I think it was more around, I think it'd be very difficult, if not almost impossible to do. In other words, you would have to basically completely stop all trade. There could be no leakage, no flows, because otherwise, if the U.S. is standing up Bitcoin as its reserve asset in theory versus everyone else, the East in using gold as their reserve asset, you wouldn't be able to do any trade in between at all, because otherwise you're going to be creating a de facto ratio of gold to Bitcoin. If you start moving oil back and forth, for example. So I just don't think it's possible to completely stop every trade between the two blocks for practical reasons. I mean, even in the Cold War, the USSR and the US still traded. And so now I would concede completely that it would still be a productivity contest, right? So we frequently have heard people say, for example, in the Bitcoin community, let's revalue gold, buy a bunch of Bitcoin with the revaluation proceeds, and then we can sell our gold and we can rug pull the Chinese and the Russians with all the gold they've bought. And that's fine. In theory, that works, but there's always a second side. There's always a second side of the ledger. There is always what next that one has to consider. And what next in this case is China would go, oh, okay, the price of rare earths is now 2 Bitcoin a pound. Have a good day. And just like that, the Bitcoin would have flowed back to China, replacing the gold. And so it really comes down to who's the most productive. And that is why it's so important to invest for both of these sides, investing in AI, robotics, etc., as they are, and who's going to win that productivity contest. And gun to my head, China's winning it now, in my opinion, based on what we're seeing. And you can, and I say that not because I'm I have a bias, But listen to what the China hawks are saying. Listen to what they're whining about. Oh, China's producing so much, so cheap. Translation, China's more productive than the US. It's that simple. Long-term interest rates going back 100 years. Well, two reasons. The first is because for a lot of that time, we were under a fixed price gold standard. And under a fixed price gold standard, you have to realize sovereign debt has no default risk because the government can always print the money. And so sovereign debt really has only inflation risk. And if you have inflation risk, when you're on a fixed price gold standard, when the government starts to inflate, interest rates don't necessarily need to skyrocket much, much higher, but rather the gold starts to move, right? You get people showing up in the US in the 70s going, give me my gold, give me my gold, give me my gold, give me the gold. And so the movement of gold is the release valve, of the risk of if there's too much treasury issuance, if there's too much inflation, if the deficits are too big. That gets you to the second reason. Once you go off a fixed price gold standard, post 71, then anytime the debt gets too high, your dollar's devalued. So the bonds lose money on a real basis rather than on a nominal basis via higher rates. That's how bonds would lose money. So that's the reason for it. And so, it's important to understand that you're going to lose on a real basis. That's why you're going to pay it every dime you're owed. But the government's not going to be starved because rates move higher. They're just going to devalue your currency. And so, people say, well, we're going to get Japan to invest $550 billion in reshoring. Okay, great. With what? Are they going to sell $550 billion of assets they own here in our capital account in order to fund factories to reduce our current account? Or are we going to give them swap lines, basically turn that all into collateral, with the capital account into collateral to invest on the other side of the ledger? And that's just QE. That's just Fed balance sheet expansion. That'll weaken the dollar. And that certainly can be done. But again, if we do that and the dollar weakens, that's going to be inflationary and go back to sort of square one, which is how many long-term treasuries do you want to hold as the dollar gets meaningfully weakened to reshore here? The answer is you don't, and you can't. So from a national security imperative, because if those treasuries buy you a lot less stuff, if you are, say, China, all of a sudden you have you've reduced ability to import goods, becomes a national security threat. If you're Russia and the real value of your commodity, of your FX reserves, get reduced by inflation, that's a matter of national security. It's basically stealing other nations' FX reserves. So that's why they're going to gold. So in my opinion, they will continue to go to gold. And it's in the U.S.'s interest for them to go to gold. For the U.S. to reshore, rebalance everything we say we want to do. End of the day, dollar's got to be way, way, way lower, way lower.
Clive Thompson notes that it's remarkable to see a Bitcoin-friendly company steadily increasing its gold holdings at a time when U.S. debt keeps climbing far beyond its 1971 levels. He argues they're simply responding to an environment of rising geopolitical risk, falling rate expectations, massive fiscal deficits, and record central bank demand for gold. With roughly $300 trillion in managed liquid assets worldwide, even a tiny shift well under 0.2% into gold could absorb an entire year of global production. Meanwhile, heavily indebted governments like Italy may be tempted to reclassify central bank assets as their own to make fiscal metrics appear healthier, a move he sees as political sleight of hand. Clive Thompson also observes that recent trading disruptions at COMEX revealed how fragile the futures-driven price structure may be. When an overheating failure halted trading and prevented short sellers from leaning on paper futures, spot gold abruptly surged about 5% and held those gains, a jump he interprets as the market briefly displaying an unrestrained price. While some view the timing as conspiratorial, Thompson avoids that frame, focusing instead on the simple mechanics. Once the artificial downward pressure from short futures disappeared, the underlying physical market quickly reset higher. Let's get back to the interview.
And yes, isn't it amazing that a company which is a supporter of Bitcoin decides to own gold, and actually a lot of gold and more gold, because quarter by quarter the number of ounces or kilos or kilograms of gold, or tons of gold in this case, it owns is going up. Now, obviously their other main asset is US dollars, because they're holding US treasuries. And we all know what's going on with the US government in terms of the debt, which is continuing to increase as a percentage of GDP year after year after year. If we go back to when the United States was on the gold standard in 1971, debt to GDP was 25%. Well, I think, first of all, I think they're doing the right thing, and I think they know what they're doing. They're no fools. Buying gold is a smart move in the environment we're in. After all, we've got a lot of things which say that gold really should go higher. We've got the geopolitical risks around the world. We've got the expectation that interest rates will come down in December. We've got very large fiscal deficits out of the United States, which are not being properly addressed yet, and maybe never will be. We've got central bank buying at the rate of, over 1,000 tons a year, and probably going to be at records going forwards. So there's a lot of things going on in the gold market to say it should go higher, and they're not going to go away. But there's two things I think which will push the gold price higher in the coming 12 months. The first one is change in asset allocation amongst those who have their assets advised or managed by others. And we're talking about something like 300 trillion of managed assets, of liquid assets in the hands of millionaires or wealthy people. This would be bonds and equity. I'm talking about bonds and equities, really, not property or anything like that. So 300 trillion. You only need a very, very tiny proportion of that, less than 0.2% of that, to move into gold, and it will absorb the entirety of the annual production of gold this year. The Italian central bank, like many central banks, is not owned by the government. It's effectively privately owned by the banks. And what government wouldn't like to get their hands on some asset in order to reduce their deficit? So if they can find a way to move that asset into the government's finances and call it a profit, doesn't mean to say they've got to sell it. They can just, if they start with nothing and end up with an asset, they've got a profit. And if they've got a profit, they don't then have a deficit, or not such a big deficit. They can potentially say that their liabilities, which are well above the European Union's guidelines, are not as their liabilities are not as high as they should, as are made out, because they now got them covered by assets. So I think it's that's from a government point of view, of course, from another point of view, it's outright theft. But from the government's point of view, they're doing let's call it an accounting trick. By if they take those assets and say it's ours, they're basically creating money or assets out of thin air, which will improve their financial situation, because countries like Italy and France are in dire straits with the level of their debt. Well, it was very interesting on Friday where we had that very long outage on Comex, where it was an overheating problem, and they weren't there was no trading, and they weren't delivering prices, because as that happened, the gold price on the spot market shot up by 5%, and it stayed there. It's gone up again today. So I think what was happening, if we assume that there's shorting going on Comex to suppress the price, suddenly, whilst the suspension of trading might have given the shorts a breathing space, the real and true price of silver came out, and that was the period when it jumped by 5%. Now, obviously, there's going to be conspiracy theorists who say, wasn't it very convenient that it broke down just as silver was hitting an all-time high? But I won't go with it. I don't think I want to trade on the back of a conspiracy theory, but it's what happened, and suddenly the shorts weren't able to suppress the price by selling it for the futures, which would have brought the spot price down, and the spot price then found its own level at a much higher level than it had been the day before.
Gold is steadily asserting itself as a haven amid rising sovereign debt, persistent fiscal deficits, and growing geopolitical tensions, all of which undermine confidence in fiat currencies. Increasing institutional demand, record central bank purchases, and episodes where market distortions temporarily lift, such as trading outages that reveal the true spot price, demonstrate how the metal reflects real-world scarcity and strategic value. Even small shifts in global asset allocation into gold could absorb significant portions of annual production, showing how sensitive the market is to reallocations. These dynamics reinforce gold's role not just as a hedge against inflation, but as a critical anchor in a financial system strained by imbalances and uncertainty. How might continued central bank purchases and rising institutional demand influence gold's price and its role as a strategic hedge over the next decade? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.